What is the outlook on the Hong Kong market? Because a large part of the story has always been about tech. But now, as you see the index being diversified into other segments, it seems like the message going out is that there is greater value and value elsewhere as well beyond tech in the region. And so are you exploring those opportunities?
Yeah, we don't have a lot of exposure specifically in Hong Kong. There's a couple that we have. So we've got an Asian tech basket, which is mostly concentrated in Korea and Taiwan, but we do own Alibaba and Tencent within that basket. And we think that they're materially undervalued now and excellent secular growth stories. I think JP Morgan, for example, has suggested that around 75% of MSCI China, or the Hong Kong listed China, is now already been affected by some form of regulatory oversight. So we think that a fair bit of that issue is arguably in the price. Although, from a broader perspective, we could still see some multiple compression at a broad market level. The other sector that we really like is Asia Pacific banks, and that's a sector which is deeply undervalued. So our basket trades on 7 times forward earnings, a dividend yield of 6%, a price to book of about 0.6. It's quality adjusted as well, so it's got lower leverage than the broader index. And also it's positively correlated to high yields and therefore is a hedge against higher interest rates in our view.
And on high yields, Nicholas, we're hearing so much about Asia high yields at the moment and what they represent in terms of an opportunity. In terms of the way central banks are behaving, of course, we've had RBNZ moving today at last, but only by 25 basis points. What's your outlook on the sort of central bank and rates view from here?
Yeah, I think the Fed have been very clear post and certainly the nature of the price action changed post the FOMC, and I think that's going to be important for other central banks around the world, clearly starting with the RBNZ and others in the region. The Fed will likely start their taper in November. They'll probably complete it by the middle of next year, and rates could rise after that. But I think, interestingly, the pressure that the tightening in the labour market in the US and then the broader pressure around commodity price inflation, specifically energy price inflation, will just probably reinforce that pressure to potentially bring forward policy tightening, even though the way to look at energy prices is as a relative price. Producers win and consumers lose out of that. So it is complex, but the way we're looking at the price action is the bond yields have started to rise again and cyclicals have started to outperform, and that's really our preference, and that's giving us a bit more of at least a cyclical bias leading into year end.